good afternoon and welcome to you all to the online debate organized by the Florence School of Banking and Finance within the initiative Bank Board Academy. Today's topic is margin call, how to navigate the energy market turmoil. My name is Elena Carletti. I am a professor of finance at the Bocconi University, and I'm also the founding director of the Florence School of Banking and Finance and a non-executive director at UniCredit. I am delighted to chair the debate today and would very much like to start by welcoming our two speakers. We have Alberto De Paoli. He is the Chief Financial Officer of Enel S.p.A. and the entire group since 2014. He joined Enel in 2008, and then he started at Enel Green Power, and then he was head of the group strategy, and then he became the CFO of the group. Then we have our old friend, if I may say so, Klaus Löbler. He is the chair of the CCP Supervisory Committee at the ESMA in Paris. And before that, he was the head of the oversight division of the ECB. And in that position, he started collaborating with the Florence School a few years back. And before that, he was in other position, including the Bundesbank. So thank you to both of you for joining us today for the seminar. And before we start with the seminar, let me just give a few introductory remarks on the overall initiative of the Bank Board Academy. So this initiative was born now a couple of years ago, and it is mostly directed to non-executive directors, but in general to all the constituencies that have to do with boards of banks. And the initiative aims at building a community of board members and help them improve their skills and understanding of their duties and the responsibility in an open and policy-led environment. The initiative consists in online seminars like today, but also training initiatives. This is the first event for 2023, and the next one we are going to have on March 8th, an online seminar on the SREP methodologies and challenges. And on April 17, we are going to have a physical meeting organized with a single supervisory mechanism in Florence. So we are hosting in Florence the meetings between NEDS and the SSM, and this meeting is by invitation only. And then we will have the training course for 2023, tentative date 8th of 9th of June in Florence. So given this, let me come back to today's seminars. We know, where does the seminar come from? We have experienced in 2022 a big turmoil for energy companies. The companies experienced a substantial increase in the margin calls for the derivative position. This increase in the margin call was due to either the reduction of gas supply or changes in the existing contract, therefore a renegotiation. And this situation of stress led to two implications. One, the companies experienced sudden liquidity needs. And the second, there was a center clearing that also experienced tension. So what we thought of doing today was to first better understand what really happened in the market, and then what factors led to tension and what this implied for the market players. Clearly, Enel was and is a big market player in the energy sector, and the liquidity in the market and clearing, and potential implications for regulation, although I know that the regulation is still in the making, so this is also for future discussion. So with that, we start with Alberto De Paoli that will tell us about the experience in the market, and then Klaus will comment and bring in more the implication from the public more at large and the markets. And after that, we would like to encourage a conversation with the audience. So we have already some questions, but I would like to encourage again all the people attending the seminar to put their question in the Q&A chat in the bottom bar of the screen. And with this, let me give the floor to Alberto. Let me first of all thank again both Alberto and Klaus for being with us today. It's a real pleasure. Alberto, please.
Thank you, Elena. Good morning, Klaus, and thank you for having me here in discussing such a topic. I'll take 10-15 minutes to share with you our experience of this strange 2022 that has been a very, very tough year for a lot of aspects. Let me say that it has been a stress test for a lot of things that we were accustomed to do in Europe, the way we fulfill our sourcing needs, the way we price the energy, the way we work on the financial market, everything was under a stress test. I do think that now we can take a lot of lesson learning. In 2022, we are still here, we are still alive. So I think now it's the best time to move a lot of changes in what we were accustomed to do. Europe is acting in all the fields, frameworks, new funds, and reinsuring supply chain, pushing on transition, reviewing financial regulation. So I think this is another year that is promising to move a step ahead. I want to share with you what we experienced along this year. First of all, one number for all on the margin call, only to attract your attention. So we were accustomed to have an exposition on margin call on a normal year in the last 10 of around 100 to 100 million euros. We got in August 15 billion euros with margin calls on one day of 2 billion euros on average in the central week of August. This was the very point that so happened in August. Why we were so exposed to the price increase? For a simple reason that is common to all the integrated utilities working the way we work. We are risk adverse 100%. We have policies within our company that makes impossible to take risk on higher than a very, very little thin part. So everything that we have as an open position has to be closed at the time in which the open position is in the company through something. What is the final outcome on our activity? Because we are an integrated utility, we produce and sell energy to customers. This is the physical aspect of our job. And in this way, we have to be balanced, because if we are not balanced, we have an open position or with higher production or with a higher level of selling. So this is the first way in which we have to work, balancing our production with the physical level of energy that we sold to our customer base. On the second level, we need to have some sourcing to produce energy on one side, and also we have the certainty that we are gonna develop and produce our energy. So at the very time in which we have some kind of this asset and not already ready customers to buy our products, we hedge all the position in the financial markets. That's why we often said along the 2022 that this problem of extra profits for a company like us was not a real case, because everything we sold last year was hedged 1-2 years before. So we don't take any kind of spike in the year in which we enter. So this is exactly what we have done now for 2022. What we do is when we have some gas availability from contracts, or we have some energy that we are gonna produce not already sold to customer, we make some forward contract in the market. What happened in 2022? We sold in 2020 and 2021 our gas availability in the market at prices that at that time were prices set by the COVID prices, so 15 euros. We don't wait any time to have a better price because of our policy of risk. At the time in which I see a price in the market available to buy my gas or my energy, I have to sell it. That's why I had prices at 15 euros in my contracts. When gas price went to 300 euros, I was asked to margin all the difference between 15 and 300. That's why, because I have huge amount of gas and energy sold in the market, I had to make margin calls for around 15 billion euros. Gas at these prices and so what we experienced for the gas prices is several different topics that one on the other created, increased, and then make an over increase. Also the financial market and the way in which the margin calls suddenly rose determine a part of the increase in the prices. If you look at this different stage, we can make this classification. First, exiting from COVID. Exiting from COVID was a time in which suddenly demand went up, and so sourcing was not ready to fulfill the sudden increase in demand. First step of price increase. Then this situation were so starting to be normalized. The war, the Ukrainian war, at the very beginning was a risk premium on the risk that this war can began an energy crisis at the very beginning. And it was the second step of gas price increase. Then we had a third one that was along August, where two things happened. One, the first cut of Russian gas put some companies in distress because were the company that had direct contracts with Gazprom and had the necessity to go and buy at any price the gas in the market to fulfill their physical obligation. Second, to fulfill the stock, where every country and every company in the country got the same request to go to the market to fulfill stocks and buy gas at any price. This was a circle on the gas prices. On top of this circle, some speculation ever present in every market. And this was the final number that we got. At that time, also the financial effect of having an unsustainable margin call for some companies forced this company to go to close their financial hedging contracts, buying at any price gas. So this was the circle that at the end, lucky to say, was stopped, because I do think that the very first stop was made by the fact that the stocks were empty at the end, and then some discussion on European level around the cap on the gas, notwithstanding now is set and it will be activated with some triggers, but only the discussion around this put a sort of threshold around the possibility to have a very, very high price. Now situation is better, but I do say that for me, for Enel, we have a very, very big financial shoulder, and we saw in advance this big wave coming, and we have the chance to increase our liquidity position by far before, then when the wave hit us. Because if we had a combination of these margin calls on one side and a very, very big regulatory credits, because also the various countries with the various measures to front the crisis, closed some of the relevant financial flows that we had for in all the years. So what I say is financial system worked well. I think that also discussion with the European community on the various frameworks, the availability of financial aids from the single state that acted in that way, and also we have acted with our Italian government to have an umbrella for the future possible shocks that we may have, is something then that happened. On the other side, also discussing around to have different way of not only cash to have this margin fulfilled is something that is has been relevant right now. So it's still 100% stick to cash commitments in this market. Is the way in which I think we have acted. Some companies have been used this financing. Also, we know some German companies had used some financing to have these financial aids. Also in France, also in Austria. So somewhere in Europe this happened. What I think is, and so let me give a couple of points and then we can discuss. One is the system is perfect, but with this level of shocks, not only this system of margination, but as I said, also the market design, also other aspects of this big energy market in Europe need to be reassessed, or to, on one side, avoid that future crisis of gas or fossil fuels may impact in such a way in Europe, or in the other side to have some measures that can be adopted in the shock time to have a different way to react of the whole system. On the other side, I would say volatility is in the energy market clearly moving towards transition, if the transition will be achieved also in increasing the level of independence of areas like Europe, like United States. So having a clear level of independence that is not to have a different dependencies, but to have a real independence, may drive towards a lower volatility in the energy market. And together with the lower volatility and a new market design, this I think is the final way in which we can manage the normal way of living. Then having some measures, and I think Klaus will address this very point, not only to manage normal situation, but also to address some particular shock times that we have experienced last year. And I hope we will not in the future.
Thank you very much, Alberto. This was very clear and very factual in a way. And I'm sure that Klaus will take up some of this. Let me ask, maybe before we go to Klaus, a question that was already put in the Q&A box. Which kind of margin calls did Enel receive? Variation margin calls, so daily exchange of gains and losses, or although initial margin calls due to higher marginal requirement from CCP counterparties?
So in that, you ask in that specific period that I said, in this July, August, well, in this period, we received variation, initial margin change, and variation margin. We got also overnight asked, and so the intraday every day, but in every aspect of the margin calls in that period. And clearly, as I said, it's the way in which you can have some estimation of what can happen is not 100% in tools that we have, because mainly on the variation margin, algorithms that are used are not public, as it's not easy to have looking at where the gas is and what could be the night or the day before the level of margination will be asked. It's very difficult to have this estimation.
Okay, let me stop here, and then maybe after Klaus, we can also go back to where you took the liquidity from somehow. You said that the shoulders of Enel are big, they're stable. I mean, you are, of course, a big company, but maybe we can discuss more where the liquidity was coming from. How did you deal with this? But before we do that, let's go to Klaus, please.
Thank you very much, Elena, and thanks a lot, Alberto, for this indeed very clear setting of the scene. I appreciate very much, and I can echo quite a number of the points that you have been making. Actually, indeed, throughout the last year, we have been witnessing, as you have called it, real-life stress tests. And unfortunately, this comes directly in the suit of already high stress situations we had faced before with COVID. So it is indeed a generally quite tense environment. What we have seen in 2022, again, the background, of course, of the unfortunate and unlawful Russian invasion of Ukraine has affected the commodities markets at large. And I think it's worth putting this into context that beyond the energy and gas markets, we had also seen stress in some other areas such as agriculture or metals. However, it is also evident that the most pronounced movement in terms of price movements and subsequent also on the margin side has been on the side of the energy and gas. And in particular, as you have described, for the reasons we have seen a major peak around August last year. Perhaps it is worth noting that since the peak we have seen, the prices have fallen significantly. And again, it's probably a combination of different aspects. It's import substitution, it's also the comfort provided by the storage levels for this winter, but also to some degree the mild winter, which have contributed to this. But as you also pointed out, Alberto, whilst the prices have fallen significantly, the volatility remains high, probably on average at a level that is 2 to 3 times higher than what we have seen in the past, which is a signal of the nervousness of the markets. So clearly there is still an issue which is underneath and which is going to accompany us for quite some time. And again, it's also clear that at any time, if there are significant developments, also the prices may again move in the opposite direction. Having said this, and coming to the topic of margins, the movements on the side of prices and on volatility have a direct bearing on the aspects that we see in the field of clearing, both central clearing and bilateral clearing. And given that a lot of the related derivatives products are centrally cleared on central counterparties, indeed, we have seen also pronounced spikes on the side of margins, both initial and variation margining, again, given the normal figures, also perhaps picking up on what you said, clearly the bulk of margin calls is on the side of initial margins. That is a function of the risk management. What I also would like to stress is that, and this is something which in particular to those who are not as close to the markets, margin calls are nothing like, as it is occasionally described in the press, a windfall for central counterparties. It is a function of risk management and a direct correlation to the level of prices and exposures and resulting risk from potential losses that need to be covered by appropriate collateral, which is the margin. So if prices increase, if exposure levels increase, if risk increases, this directly feeds on in an increase of margins. This is a function of risk management, and CCPs in their heart are risk management and risk mitigation infrastructures. They are not assuming own risks. And of course, one consequence of their setup is also that if they don't cover their risk appropriately and if there are losses, it will be passed on to the community of participants, of clearing members, and clients through the loss allocation mechanism. So again, this is just to stress the importance of the margin processes. Having said this, and again, we are currently seeing a situation where the margin levels have also decreased again. When we saw the movements last August in particular, it was actually comforting to see, as you said, the markets functioned. And in particular, the clearing segment remained stable. And there were some immediate supporting reactions. Just to give one example, and I think you have also alluded to this, Alberto, ESMA at a very short notice extended temporarily the range of potentially usable collateral to provide margin calls by including certain types of bank guarantees and public guarantees. Actually, for those who know, the process usually takes about 1 year to change technical standards. We have been managing to do this in a very protected period of not even a few weeks. Of course, what also helped to alleviate the situation was the very targeted support by EU member states to either individual firms or a range of firms that basically addressed issues on the availability of liquidity and ability to cover margin calls at a short notice, which calmed the situation. What we have now, and perhaps to very briefly touch also on the new instrument that has been put in place by the European co-legislators, which is the market correction mechanism, or rather a price cap for a very specific type of transactions, basically a number of exchange traded derivatives with maturities between 1 month and 1 year that are being traded at a pronounced trading hub, the TTF platform that is located in the Netherlands. This is something which is aimed to provide a ceiling in terms of prices to avoid spillover effects on the economy, on the consumers that may come from significant increases in prices. This is a quite complex mechanism which has clearly defined mechanisms on when to activate the price cap based on a number of elements like a threshold, but also a differential to reference prices that exist otherwise. It also has a mechanism for the deactivation of the price cap, both in terms of following prices, but also, and I think this is important, if there's a perception that the security of supply in the European Union may be negatively affected by such price cap. This mechanism is in place since yesterday, actually in force, and in the surrounding of the establishment of this mechanism, 2 authorities, ESMA, but also ACER, which is the energy regulator in the EU, have been asked to provide an analysis of the potential implications of this. And both authorities have published a preliminary report already 1 week ago, and we are supposed to deliver a final report also indicating data-based developments by 1st of March. Again, it's worth noting that beyond the immediate application on one particular trading venue, there's also a foreseen assessment of a potential extension to other trading venues beyond the Dutch trading hub that is supposed announced by the Commission by end of March. So clearly there is further work to do. Perhaps let me just spend 1 or 2 minutes on some of the potential impacts, because clearly, in particular, the report of ESMA indicates that so far there has been no perceived significant impact on the energy derivatives markets, which is unsurprising because currently the prices are low, and also corrective measures that are needed, for example, on the side of adaptations to risk models of CCPs have not yet been enacted. And of course, markets are still evaluating how to position themselves to this. But having said this, we see some potential future consequences of the mechanism on the side of ESMA. In particular, we are looking very closely at potential moves from the exchange traded and centrally cleared segment to the over-the-counter, the off-exchange business. We also are looking whether there may be a substitution move to other maturities, other products in the derivative space not covered by the price cap, but also whether the trades actually move to other trading venues, including potentially some outside the European Union, which would of course be out of the remit of the market correction mechanism. That is something which, given that derivatives can in theory be traded everywhere where there is a trading venue, a market, something where we put a close eye on what may be directional moves in this segment. More specifically on the side of central counterparties, and here we are again in the area of the potential impact on margining. A price cap affects the price formation. And this has a very direct implication for CCPs in two dimensions, because it impacts the potential estimation of a CCP's exposures if there is not a reference price which reflects market realities, which actually is the price at which the market participants consider to be a real value of a certain product. There is an uncertainty that enhances the risk. At the same time, in terms of default management, of course, if there is a default by one of the participants in a CCP, the CCP needs to realize the existing transactions, and that requires that it needs to find a buyer to the portfolio of the defaulting member. Again, for this, you need to have a price at which there are people willing to actually buy. So there is an impact that needs to be looked at. This has an implication on the calculation of margins, and CCPs are expected by regulation to be conservative here and to make assumptions that are realistic. This is something where we are currently monitoring very closely what adaptations may be taken on the side of the CCPs to position themselves in respect of the price cap. Having said this, and this is also part of what we are intending to look at in today's conversation, there's probably a need to take some wider reflections. And perhaps just to indicate 2 or 3 points that I would consider also to be interesting in the discussion. First, with what we have witnessed over the past year, in particular in the derivatives space, there is a question on what is the role of non-financial companies in this context. And in particular, as Alberto was mentioning, there are the energy firms which can take a lot of different functions. They can be suppliers, they can be traders, they can be utilities, all of which are very specific profiles, very specific needs. And we need to see how this can be supported by the design of the current trading and clearing setup. There are issues about access. And it is worth noting that not all CCPs have the same type of access structures. In some CCPs, non-financial counterparties may become direct clearing members. In others, they need to access central clearing through a clearing member, which usually is a major bank. There is also a point, and here I would like to echo what Alberto said about transparency and predictability. Indeed, that is something that has been looked at by ESMA and is also part of our international engagements to make sure that there's a higher degree of information available to clearing members and clients in terms of what they can expect in terms of margin developments. And perhaps the last, and probably from my perspective, the biggest lesson from the various emanations of the crisis is the issue of concentration. And we are talking about a market here where the activities are concentrated on a small number of trading venues, central counterparties, major clearing members, and major energy firms, who are all interconnected, who participate not just in one market, in one CCP, do not yet use one clearing member. Here's an issue again of transparency of data, of access to information sufficiently granular and sufficiently real time to be able to understand buildups and developments. And that is an area where I hope that some of the reflections we're currently having in the context of the review of the EMIR framework, of the legal framework for clearing, that we can pick this up and see how we can improve the understandings of these considerations. With this, I'm looking forward to the questions and the discussion.
Thank you very much, Klaus. I think we have lots of topic to discuss. Both of you were really excellent in terms of putting all the points to the table. Maybe, Klaus, before we enter, there is some question on whether the market is forward or future, and if the market is future, whether there is daily settlement, will it be possible making margin calls daily? Can we maybe tackle this and then we go to the broader discussion? I would like to go back to Alberto also on the financing of this increase in margin calls. Please, Klaus.
Let me not go into too much detail on this because it is a very technical question.
Yeah, no.
But it is evident that what is currently being addressed is a subset of the transactions that are relevant in the context of the supply. And one area which is not covered is the spot market. Again, there are various reasons for this, and of course, but also is not covered is the whole over-the-counter, the off-exchange trades. And this, again, is a question on the comprehensiveness and on the potential impact of any measure that is being taken by selecting a subset, a relevant one, but not the complete picture.
So maybe before, Alberto, we go back to the issue of the past and how you find, I mean, Enel, but also, sorry, I was on mute. Before we go back, I was saying to the issue of how you finance this increased demand on liquidity on your side. How do you see this price cap? I mean, in particular, while Klaus was speaking, but also during your intervention, Alberto, I was thinking, are we expecting it to be a sort of whatever it takes type of effect, meaning that the announcement is enough to calm down volatility and in a way will never be binding? We don't expect it to be binding, at least not very often. Or do you think that it will not be such a powerful instrument in terms of announcement effect only? Because it is true that the gas supply, the stock, and everything has come down, but the announcement of the price cap has helped decrease the volatility. I think you are on mute now, Alberto.
We, at the very beginning, pushed a lot to have you discussing and try to find a way to put a price cap in the market. Clearly, technically speaking, it's not easy. Discussion took a lot of time, and I think now it's a good news that it's the mechanism is improved. Clearly, it's based on a lot of things because we know that also it has to be also fulfill the needs of having physical furniture, and so not to have any risk of furniture, and so the system is that way. Let me say that we have experienced the last year an energy crisis without a real short of gas. Europe at the end, also because of a real decrease in demand of gas, had not, in exception of some very few days, a real needs or so physical shortage of gas. So clearly, all the price spike was related to risk perception, some speculation, and all the stuff. So clearly, announcements are relevant in the market. So I say, we saw at the very beginning of the discussion, the market going down in prices, notwithstanding nothing on the physical aspect happened. So we think that this is a big correlation between what the EU wants to do, also in the time in which it will be done, and some part of this price spike. So I think the umbrella is relevant every time. And so having it now, it's relevant because every one of us now is looking at the possibility that the threshold will trigger a price in a certain time in future, and we will take decision looking at this level. So that's why I think is very relevant to have it. Then we will see also if, so in future, it will be the need or the trigger events because it will come in force with the price we set. But so having it is already a relevant step ahead.
Okay, and then the other thing that both of you actually touched upon is this issue of derivatives, meaning that, of course, you want to hedge. So this is not trading. This is really, you do it for hedging purposes. So this is a pure risk management. Now, did this situation that we experienced somehow have some lessons for risk management of the energy companies? In the sense, do you think maybe you shouldn't be hedging the way you have done it in the past, or what's your view?
Well, first of all, thank you, because we have to front also some newspapers everywhere that want to compare these crises, these potential crises, with the Lehman ones. That is completely the opposite reasons, because we had utilities in troubles. Exactly the opposite position is to hedge the risk, put in trouble some companies. It's not easy to understand that the mechanism is technical, but so it's relevant to underline that it's a complete opposite way of crisis. What is going to change? Look, the point is that clearly we are working a little bit on the hedging strategy we have, not in so changing the exchanger with OTC is not something that is triggering our decision, but clearly we have to work with a higher volatility context. So we are choosing a different strategy in hedging all our position, leaving some position more open to the others that are correlated with this or uncorrelated. So it's a different strategy, but not changing the way in which we act on the financial market or the average between the OTC market and the exchange market. On the other side, this is not related with the financial aspect of our hedging strategy. As I said before, we are working with our investments and we are with our position to have less volatility intrinsically in our business going ahead. So the choice to have a full development of renewables, the choice of sell some gas contracts because we are exiting the gas business, the choice of shut down our coal plants at the time in which it will be so possible out of this crisis. All this, the fact to have a full edge between our production and our selling is all a stuff of a strategy that at the end is seeking to have less volatility within our business, and at that side having less needs to use financial market to hedge our position.
And from your side, Klaus, I mean, in a way, was such an exception. I mean, if I'm not an expert of energy market, but I allow myself to know a bit of the banking world. And typically this, I mean, to me, if I use the terminology coming from banking, it's a little bit really systemic shock, that it's very difficult for each single institution to foresee, to deal with, to incorporate in the risk management. So in a way, it's really not their fault. Let me put it this way. So it's an exogenous factor to them. So what do you see this implying for risk management and also for the clearinghouse? I mean, for the clearing system, not only for the individual companies.
Yeah, I mean, this is clearly not an exercise where you need to seek the fault of any individual or any part of the overall segment. I think what is still important to recall is that the basic assumptions that were taken to promote central clearing still stand. Because when we are looking at the clearing of derivatives, central clearing has led not only to increase of transparency and the reduction of risks to the sophistication that CCP risk management provides, it also has helped to promote netting efficiencies. All of this is still relevant. Of course, and it is fair what Alberto said, individual market participants should take a look at their hedging strategy. Again, hedging itself has a clear added value, not just for the firm concerned, but also for the wider markets in terms of stability of prices and expectations of price movements. What is for me a key point is if there is indeed a pronounced and continued trend away from central clearing to OTC and bilateral clearing, that one has to take a clear look what this implies in terms of risk. Because if it is because there is a perceived lower cost in the bilateral space, it's probably an indication that risks are not appropriately priced. And this has consequences where we should take a very close look at these kind of developments. Having said this, and this is a bit more on what types of improvements there are, I mentioned already some aspects which for me are key, in particular enhancing the access to data and information on concentration risk. This is still for me the center point on all regulatory reflections on how we can make sure that we avoid unforeseen and uncontrollable developments that take us by surprise, both the market participants and the regulators. However, there are a few smaller steps, and I mentioned the access models of CCPs, but also, and you mentioned it very much at the beginning, Elena, and I don't think we came back to that, the procyclicality aspects of margins. Again, we had already launched at the side of ESMA to pick this point up long before the events of this year as a consequence of COVID, reviewed the quite elaborate standards we have for APC tools in ESMA. We have been doing a recalibration and a reassessment both after the March events and now after the August events. And we still feel that with some small adjustments, our framework is appropriate. But there may be other aspects when it comes to predictability where further work may be needed. What is important here, however, is that all these activities do have a European focus, but are also aligned internationally. Because again, I think I mentioned this, the EU markets are in direct competition here with other venues. And to the extent that there are misalignments, this is also not helpful in our ability to make sure that we have a sound and efficient financial system.
Thank you, Klaus. I am tempted to ask you to follow up on a question that is in the chat, whether you see a regulatory strategy to reduce this systemic risk in clearing. But I know that you are working on future developments, and therefore I know I shouldn't ask this question, so I won't. But let me come back instead. We have still 10 minutes, and I would like to touch upon two topics. One, how energy companies finance the increased liquidity needs, and the role of, again, markets and possibly banks in financing these liquidity needs. And the second, government intervention. So maybe I start with Alberto to see how you reacted to this increase in demand in liquidity. How did you satisfy it? And then I go to Klaus more for the government part, because ultimately this was very much a national response, if I understand, with the use of state aid. And of course, the Florence School is very used to discuss state aid and a level playing field relative to European solutions. So please, Alberto, first with how you dealt with this increase in liquidity.
Well, look, so we work in a normal time with some risk threshold around our liquidity available. That is that we have to work within a survival period of 12 months. This is what we have as a threshold. Survival periods for a company like us is something that is ranging around 20-25 billion euros that we have as a liquidity backup. This liquidity is composed usually by cash for, say, 30% and credit line available for the rest. At the time of the sudden increase in the margin calls, as I said, together with the working capital impacted by regulatory measure in all the countries in Europe in which we work, we had an overall increase in needs of 25 billion euros, for margin calls and 10 for working capital issue. So we had the necessity to go to the banking system. And also in this case, I would say we have big shoulder, we have a big relation with the banking system. The banking system were at that time very selective. So they selected us. So I had the chance to increase my credit lines suddenly in a very, very proper manner. I didn't suffer a lot, but so we know that in that period, so this selective screening was not the same for all the company, or the company with a different size. Also at that time, I use a certain amount of commercial paper in my normal financial structure. So clearly, in that period, my survival period went to a very, very low level. So I worked for some time under my survival period, because the commercial paper that usually are three months of expiration, this market was closed suddenly at the same time, and only one market of 1 month was opened. And on the other side, with the risk that the month after was closed completely. So this was the risk that we had in that period. And the last one, and Klaus, I think, know very well, is that the settlement time of so the margin calls at that period, whilst I'm saying 1-2 billion euros in a day, was not in line with the time needed to draw down the lines. So we had this disconnection between the needs to have money the night for the day, and so the bank system and the credit lines that need, I don't know, 2-3 days to have such an amount available. So this implied for us to use all the cash we had, and also I'm giving my experience from a big size and big shoulder. But so on other sides and other shoulders, I think that also this would be a relevant problem.
Klaus, how do you see that? I mean, also maybe looking more also for other companies. I mean, in a way, what I was thinking when Alberto was speaking, for example, you were talking before about concentration. You were more on the clearing side probably, but now looking at the energy market, I was thinking, of course, Enel is a big company and they could afford also to convince banks to lend to them. But what about the others? So does this call for also for concentration from the energy company side?
Yeah, thanks, Ella. Actually, to be very clear, when I refer to concentration, it refers to all layers. And you're absolutely right. There is an issue on the side of the non-financials of the energy firms. There's an issue on the side of the banks. Those who are actually willing and still engaging in this business of providing liquidity lines to energy firms is a rather foreseeable number of entities, let's put it like this. And we also need to be aware, of course, there are issues coming from bank regulations, such as large exposure limits, that also put a cap on the ability of banks, even if they want to engage in this kind of facilitation of liquidity lines. So it is something which requires a very close look in consultation between the market regulators and the bank supervisors. There is not a very simple way, and again, it is not just because there is some bad intent on the side of CCPs, for example, that they insist on either cash or highly liquid, high quality assets. It's a regulatory requirement, which is a reflection of the fact that in terms of risk management, CCPs need to realize at very short notice those margins if they need to cover for a default or a potential loss. Of course, to the extent that you have a layered participation model, that the bank acts as direct clearing member and the energy firms are clients of the banks, you have some form of cushion, because the banks itself can decide to take a wider range of collateral from the clients or work on the basis of credit lines, as Alberto was saying. That is an aspect which plays a role, but overall, the concentration aspect puts significant limits. So we clearly need to take a more wider look at the overall market structure as we go forward.
Thanks, Claude. I agree. I really agree. Last 3 minutes, Alberto, government intervention, mostly national. What's your view on this for the past and for the future?
Well, I think that so in this field, clearly we were all unprepared. So now I think that we are setting the proper framework, because in the future we will have a time of reaction that now is good. Clearly, governments acted. EU acted very rapidly in giving the possibility to single state to do something, and this is very welcome, because, as Klaus said, all things that in the past we had, I don't know, 6 months, one year to do now. So EU show that also in a crisis, the speed up of all these processes has been very useful. I think that all the measures adopted, in Italy, the Export Credit Agency, this is our Export Credit Agency, giving guarantees to banks to offer loans to companies only to be used for the margin needs, is a proper instrument that now is in place. Clearly, so it took 3-4 months to have all the mechanism in place, approved and others. Clearly, it was not a chance if in August we went to 20, 25, 30 billion euros, was not in place. But okay, so now we are here, we survived, and I think now all the frameworks are almost in place. I think all the stuff that Klaus and ESMA now are doing to complete this new picture are so in a proper way and relevant to be defined. Now, I think also, let me say a last thing, that is also governments made a huge deep into this sector in all the aspects of social impacts, geopolitical impacts, financial impacts. So it's also for them to rethink on the energy sector as a central sector of the life of the community, that now will address a lot of things that these 10 years of nothing have a little bit shattered. So we are learning step by step. We are not questioning intervention. A lot of good intervention, some intervention that may be a bit better done. But clearly, a longer crisis is a way to understand and then to move to another step. So this is what we see. We are exiting the crisis. I hope it will trigger a big change in Europe in every field. I'm convinced that it will happen.
Klaus, last word. I mean, of course, let me say, I fully agree with what Alberto said. At the moment when the crisis hits and everybody was unprepared, this was the only reaction. But there is a past and then there is a future. So going forward, should this be the right way of reacting, should the situation like this come back again? And in particular, I'm thinking, again, from the banking sector and the government, as long as we are giving guarantees and hopefully they will never be used, and then is an announcement mechanism, right? But should this not be the case, then this open, of course, the door of other problems. But Klaus.
Let me not add too much, in particular on such a sensitive issue such as state support. I mean, I mentioned in the concrete situation, it was a significant element to stabilize the situation. Going forward, I think, and hopefully the reoccurring stress events will allow us to take a step back and reflect on what we should do. That is, for me, a necessity. And there are elements here that clearly have a systemic dimension, both in respect of the role of various players at all levels here in the market setup, for which we probably need to have a bit more thoughts. Let's hope that we take the opportunity, and for me, a very clear aspect is this is not just a national issue. This has an EU and even global dimension. So let's not take a too narrow focus here on how we can address it.
Thank you, Klaus, indeed. And let's, as Alberto was saying in his initial intervention, let's hope also that in the energy, we will reach to independence in a way or another soon. But this will not be the only market where we will have tension in the future. So this, of course, national versus European is much a broader issue that affects other areas as well. But let me stop. I know you are both very busy. So let me thank you again very much for having been with us today. We are receiving already lots of good comments from the attendees. Thank you very much. This was very interesting and very useful. Thank you. And I hope to have other occasion to have you at the Florence School. Thank you very much. And thank you to all the people that participated.
Thanks,
Bye-bye.
Elena. Have a good day.